Steven, thanks for coming on, man. Appreciate it.
Thanks, Dan. Thanks for having me.
Yeah, for sure. So you're at a really interesting vantage point, I think, right now, like looking at, hundreds of books for different companies. So I guess to ask a pretty basic question, just what are you seeing right now?
It's a tale of two cities. It's companies that are knocking it out of the park because the world now has a need to go switch to digital and sell things online. And that means everybody is trying to figure out how to do video, podcast, blog, thought leadership. And the companies that were digital are doing great. The ones that were not, that were more traditional, they're finding success if they're migrating their clients using partners that are specialists in digital. So it's hard to find an agency, though, that's not really good at digital. But if you're not on that bandwagon, it's a challenge. If you were doing more traditional, old school headshots and things that require face-to-face, it's survival mode. But 90%, 95% of the clients that we're working with are either restructuring, meaning, okay, we got to make some hard decisions to pivot, but we're going to get out of this. Or I'm happy to say the majority are in strengthening mode, meaning what can we do now to make ourselves better in the future when this all ends?
Yeah. And I guess with that in mind, so you've kind of talked about, the idea that lots of your clients are either digital or analog or hybrid. I guess out of the firms that surprise you in a good way, the ones that are stronger and so on, are there any commonalities that you see in terms of how they're thinking about this?
It's all those who are helping their clients unleash the thought leadership that exists in the owners and the leadership's head. That just seems to be really working. And it's not easy, right? There's a lot of old school businesses that have built their whole business on reputation and on relationships and through the Chamber of Commerce, and out there networking and endless chicken dinners. And those days are gone. And so taking somebody who has 30 years of experience and now trying to get them to get it out of their head, that's often difficult. So, if you have a recipe for being able to do that, Marcus Sheridan is somebody that we've worked with that I found really has a great process. You're knocking it out of the park.
Yeah. And what we've seen on our end is that I think a lot of, older school agencies, even ones that aren't that old, are having to condense their value proposition, I think, for the first time ever, right? Where it's not like they weren't doing anything valuable before this. It was just that it was more diluted because it would be, like you said, the chicken dinner kind of thing in order to win new clients and so on. So I guess, is that a dynamic? Like, would you agree or disagree with that? Like, is it really just now about condensing the value prop that's already existed, or are some clients just finding that they never really had a value prop and it was all just sort of based on networks and relationships?
No, I think everybody had a value prop. I think you don't make it long enough just on, greasing some palms, right? If you're not really adding value to the marketplace, you're not going to make it in the long term anyway. But, old school way of doing business, for lack of a better phrase, and I hate to say it, make it sound like it's denigrated because it worked. But if you can, look what we're doing today, right? The whole concept of being able to get your message across to people as they're driving in a car is how people prefer to buy. They're educated buyers now. They're listening to leaders and saying, okay, I want that, instead of meeting somebody and saying, oh, I tell me more. You know what? I stumbled across you and I need that. They're shoppers. They're buyers, not shoppers, right? They're going out and saying, okay, I want to buy, like we do outsourced bookkeeping, accounting, and controller services. And so when you need that, Google's going to be able to give you thousands of options. Being able to figure out how you differentiate and add value. Like for our goal, it's to help you increase profits. And by increasing profits, it will increase cash flow. And so often we find most of our people come to us because they want to increase cash flow. And then when they learn, well, how do you increase cash flow? First, by focusing on pricing. Pricing is the cause of not having enough cash flow or having plenty of cash flow. And understanding that science is really what allows you to get to the top of that Google searches. And what's really interesting is how many marketing agencies, in fact, I have a call with one right after we do this today with somebody who's grown 35% in the last year. Their business is booming. But what typically happens is when your top line grows, your bottom line suffers.
Yeah. So there's so much to dig into there. And I guess one question is just, it's going to be hard to figure out how everyone should price. We're not going to figure that out on an interview, but what are some of the mistakes you see? What are some things to avoid when it comes to pricing?
Well, it's actually, while it's a very complex subject, there's actually some pretty basic things you need to do. First, you have to understand this is the most important decision every business will make by far. It's not even close. A small change in pricing has a profound impact on your bottom line. I do a lot of Vistage speaking, and one of the things I talk about is how the converse of that is true. If you offer a 10% discount, depending on what your profit margin is, you'll have to sell somewhere between 30 and 50% more sales to earn the same cash profits. Because when you give a discount, all that money comes right out of your bank account. Nothing else changes. Your cost to deliver services stays the same, I should say. Your overhead stays exactly the same. So if you got a $100,000 job and you say, okay, I'll do it for 90, 95, that $5,000 to $10,000 comes right out of your pocket. And that's what causes cash flow problems. Conversely, if you can increase your prices just by 5 or 10%, that additional profit is the difference between struggling to live that American dream and being wildly successful. And if you have a 30% profit margin and you give a 10%, you raise your prices 10%, you can sell 20% less business and make the same cash. You can take Fridays off and still make the same amount of money. And so that's the first thing, is understanding how important this is. The second thing is you have to understand the difference between above the line cost and below the line cost. And this is probably the most important lesson that we teach new companies, because this is not something that you learn, in school. In business school, you'll learn it, but most entrepreneurs don't go get an MBA. Gross profit is the line. When they talk about above the line, below the line, gross profit is the line. And gross profit percentage is the most important number on any financial report. Why? Because gross profit is what creates net income. You have to look at your gross profit percentage and make sure that every job that you do, every client you take on, your gross profit covers its share of the overhead and creates the profit goal that you have. So if you want a 10% profit, just a round number, and you're $1 million agency, then that means you want to make $100,000 at the end of each year. When you price your jobs, you've got to make sure that your profit margin not only covers its share of the overhead, but also has an extra 10% to the bottom line. Otherwise, you can't make it up in volume, right? A lot of people think they can sell their way to profits. And that's a misnomer. You priced your way to profits. And so by understanding the above the line cost, which is the cost of goods sold, right? Gross profit is your income minus the cost to earn the income, the cost of the services delivered. And there's only two types: direct labor and direct materials. If you know that, then you can price your jobs right.
Yeah. And one thing that I've often struggled with is figuring out, where does sales and marketing fit in? Where do you put that?
That's a great question. It's usually the first question people ask. It's always below the line. Why? Because your above the line costs are the direct expenses. They're what the customer directly paid for. There's direct labor, that the customer, the labor that directly earned you the income. It's the copywriters, it's the podcast host, it's the people who are buying spots. It's the labor that the clients paid for that earned you the income on their time. And it's direct materials. It's the stuff you had to buy. It's the software for that particular client, or it's the ad spend, or the SEO purchases, whatever it is that your client paid you to buy. Those two costs, direct labor and direct material, go above the line. Everything else is indirect. It's overhead. The customer did not directly pay you for that. The customer does not pay for the work that the sales rep did or that the marketing firm did. That sales and marketing created an opportunity for someone else to deliver value, for someone else to directly serve the client. But the sales rep generally is not the one who's doing the work, unless they're also an account manager. You have to eat what you kill. Then you allocate it based on percentage.
Right. That makes sense. And I guess I'd love to hear your thoughts on how, specific and detailed to be, right? Because I think a lot of agencies, and we do deal with this too. We have W-2 utility players that might be bouncing between clients and other things. Should we be figuring out how to create a fancy dashboard where X part of their time goes towards the P&L in different places, or do we just live with it not being perfect? I'd love to get your thoughts on that.
Yeah, you're going to be surprised. I'm a CPA for 35 years. This is my 6th recession I've been helping small businesses through. So you don't want to get it perfect. It's not worth the cost. It's the 80-20 rule. What I suggest to clients is you want to get it 80% right, and tell your staff, do not spend more than 15 minutes a day. If you spend 20 minutes on your timesheet, you're overthinking it, because it has to be close enough for hand grenades. What you're trying to be able to do is to figure out, relative to each job, which are your clients that you make the most money on. You're not publicly traded. You don't need to go pass an audit. It just needs to be accurate enough to be able to tell, we blew it up on this job. We're getting killed on this type of work or this type of client, so that you can start to make data-driven decisions about pricing the next job or choosing the next client. We suggest, I know a lot of agencies say, we don't bill by the hour. We don't want to track time because we don't want to have that as part of our culture. And what I say is, no problem, as long as you're happy with your profits. If you're not happy with your profits, then you have to have some kind of basic labor allocation, some kind of basic time tracking, because labor is your biggest expense by far. It's 70 to 80% of your expenses when you include the health insurance and the recruiting and the training. And so if you don't slice and dice that labor cost, if you have a P&L where it's alphabetical, it's accounting, advertising, commissions, and then 3/4 of the way down, you got payroll, taxes, maybe officer's salary, right? You can't make data-driven decisions about which of your people contribute the most to profits, which of your clients contribute the most to profits. And by taking those people and allocating them above the line, and what we do with new clients is we start them with phase 1, which is no timesheets. Let's just start with moving your labor above the line and below the line based on the work that they do. And we'll do it at the company level, and we'll set up departments. We do QuickBooks, Xero, NetSuite. We suggest you want to, at the very minimum, move that labor cost above the line by department, because then you can start to break it down into teams without timesheets. Now I can start to see, okay, how much revenue did a team bring in? How much labor cost did a team bring in? That's a great starting point. That's really easy to do, does not cost a lot to set that up. And then then typically what happens is people look at the teams and say, okay, now what? I want to drill down into that team. And that's when we say, we recommend T-Sheets. It's a great software package. In fact, Intuit bought them. That's how good they were. They're now baked into the Intuit platform. And what it does is it has a real simple, on your iPhone, you can just pick and choose which jobs you're working on, hit a start button, and then when you're done, hit a stop button. If you're actually going out and doing physical work, We do project-based service businesses and nonprofits, right? That's all we really do. In the old days, pre-COVID, it actually has a geofence where when you show up on site at a client, it says, do you want to start your timesheet? But what it does is it allows you to automatically allocate the labor costs when you run the payroll, especially if you use Intuit Payroll or Insperity. Those two payroll providers have automated that whole labor allocation.
Very cool. So that's a great rack, and I think that having these things talk to each other is a big advantage. So I appreciate that. So much I want to dig into there. So I guess the first thing is, I hate it when I'm asked these questions on podcasts, so I apologize. But are there any benchmarks that people should aim for, if you want to constrain maybe thinking about digital agencies in a project-based way?
Yeah, I'm happy to, actually, because we one of the nice part about specializing, working on marketing agencies and project-based service businesses, you really get to see what is a well-run company. And a well-run company has 12 to 15% profit. And that's what everybody should be shooting for. What you see is the market leaders, the ones that are really exceptional, they have 15 to 20% profit. And that typically happens when you are specialized, right? The riches are in the niches. When you're really good on a vertical industry, you have something unique of value to bring.
Sorry to cut you off. I'm just curious about that number, because you hear things all over the place. Sometimes you hear 30%, 10 to 15. I've read the Greg Crabtree book, who covers some of the stuff. When you say 12 to 15, is that counting owners' salaries and stuff? Is that why that pie gets sliced, basically?
Yeah.
Gotcha. Okay.
Yeah. If you're an owner's salary is part of the cost of doing business, right?
Right.
You can't. You have to pay yourself what you're worth.
Right.
And then profits are after that. And we could do a whole thing on how people drive profits and why profit sharing is so powerful, and how written goals will help you get discretionary effort and get people to act like owners when you start to have a human capital strategy aligned with a financial management strategy. But that's a different day, unless you want to go there. But the real challenge is, I'm amazed. I literally look at hundreds and hundreds of small businesses' books every year. The vast majority of companies have 5 to 8% profit. And the ones that are in that 5 to 6% range have cash flow problems, because there's not enough profit to generate the free cash flow needed to cover the slow times, the seasonality, the slow payers, the pandemics that suddenly show up out of the blue, and all of a sudden you have 6 weeks where you're down. And so what we suggest is you start with profit first. Your pricing should be, and there's a great book called Profit First. You start with, how much profit do you want to make? Do you want to make 10% profit? Okay, great. Now let's look at how much overhead you've got. That's the second step. And overhead is typically a fixed cost. Sales commissions is variable, but other than that, it's pretty much salaried, rent. You're paying your accountant, you're paying your IT person, whatever it is, they're fixed. One of the secrets here to increasing profits is to convert your overhead from a fixed cost to a variable cost. Because what that does is, if your business slows down, and we're recording this at the end of 2020, who knows what 2021 is going to be? It might be winter before we really get back to a new normal. You want to have those costs of your accounting and HR and your IT be variable. And outsourcing allows you to do that. During the pandemic, we went to a lot of our clients and said, okay, we're going to lower your fees because your volume has gone down and you don't need to be doing all the work that you're doing. And right now, we see your books, you need to conserve cash. And then once you understand how much overhead you've got, then you work backwards from there to figure out, how much profit margin do I need? And if you've allocated your labor costs above the line and you really understand, what does it cost to deliver your services? What are those true above the line costs? Now you can price with data to figure out exactly how do you make that 10% profit on every job.
Right. That makes a lot of sense. And I think back to the sales and marketing thing, I think that's still what a lot of our clients and what we struggle with a lot is because there's the few, it's completely unwritten, right? You can have this blank check going to sales and marketing and put up, a billboard in Times Square if you wanted, or do nothing at all. So yeah, I don't know if I have a good question, but I guess, how do you encourage clients think about that sort of reinvestment?
Well, you mean the clients of the marketing agency, or the actual our marketing agency clients ourselves?
Your clients, yeah, agencies out
Yeah,
there and so on.
yeah. I mean, this is why we learned math in the sixth grade, right? If you start with how much profit you want to make, and then look at how much overhead each job has to cover. What we suggest you want to do is you look and say, how many units are you going to have in a year? A unit is whatever shows up on your invoice. If you're doing it by the job, here are the clients. Here is the number of websites we're going to do. Here's the number of podcasts we're going to do here. Whatever the line item that shows up in your invoice, that's your unit. It's easier when you're manufacturing. The same thing applies. How many widgets do you produce out of the warehouse? You then look and say, okay, if we got 1,000 widgets and I've got $10,000 of overhead, every widget has to have $10 of overhead built into the widget. If I want to make $1,000 in profit, I need another $10 on the widget to make 10% profit. In marketing, you got to do the exact same simple math, which is, how many widgets have you got? Let's use billable hours as an example, because that I think everybody can relate to. If you've got 10 people, there's 2,080 hours a year. Everybody's typically looks to work 80% of the time, because you got vacation and sick time and training. So now you got 1,600 hours a person. You got 16,000 hours available to you. If you've got, and just, for argument's sake, let's say, you got $1.6 million of overhead, then what you need to do is every year that client has to cover $1,600 worth of overhead when you price your jobs. If you wanted to make the same profit, you got to have $1,600 of profit baked into each job. And on a per month basis, if I did my math right, that's $150. So when you price your job, you got to say, okay, I got to make, if it costs me 50% of the revenue to do the work, I got 50% margin. Then when I look at each job, am I getting $150 of overhead? Am I getting $150 of profit? And that's how you start with defining your price point. And
Right.
Sometimes agencies come back to us like, well, it's a very competitive space, right? We can't increase our fees to get to this point. It's like, well, you only have three options. If you want to increase your profits, you have to lower your overhead, increase your gross profit percentage, or sell more at a higher rate than what you're doing now. And just like any marketing agency does for their clients, you guys know it better than anybody. What's your unique selling proposition? Where are you adding the most value? And then go find that ideal client profile and just sell to people who see that value. That allows you to command the price that you need to make your profit margins. And if you don't do that, you won't make your profits.
Right. And I think you just hit the nail on the head and probably created a lot of groaning, from our audience. And that's what we encounter in a different way from agencies, which is, we ask questions like, what's your average CLTV? What type of client is good for you? And to varying degrees, there's lots of hand wringing. There's lots of doubt and confusion. And it sounds like, having the books do what they need to do, and being able to plan effectively is just based on making kind of brave, courageous decisions and putting your foot down in certain places and about who you serve and who you don't serve. So I guess the question is, how have your better clients approached that? How have they approached the decision of figuring out their USP and figuring out, who not to take on for that matter?
I'll use QuickBooks as the example because that's what we are our largest. They have 88% market share for a reason, right? This is the most powerful system for the price. And most people only use it like Excel, right? They add, subtract, multiply, and divide and never understand what a VLOOKUP or a pivot table can do for them. What QuickBooks Pro stands for project. The Pro stands for project. It's not professional. So it's got project accounting built into it. And so what that allows you to be able to do is be able to see the profitability on each customer, on each job, on each service that you offer. And now what you do is you start to slice and dice your income statement and say, okay, who are my most profitable clients? And then who are the bottom 15% profit margins? Who are the worst clients? And let's look at what's the difference between the best clients and our worst clients. What is the hidden cost that we've got? Where is the things that we're missing in our pricing? And I'll tell you exactly what it is. It's always the same. We call it time leakage. Where are you over-serving your client? It's in project management. People think, okay, management, that's a below-the-line cost. So they don't assign it to a customer. But you can't do the job without the project manager. So it's an above-the-line cost. It's a direct labor. It's the customer interactions, the emails, the phone calls, the quality control, just the day-to-day working with the clients. Some clients are more difficult than others. We call it a PITA factor, right? The pain in the ass clients. And so you've got to build that into your pricing. Somebody's going to email you every day and ask you questions and say, where is this? How come this? And they're going to nitpick. They have to get priced differently than somebody who is your ideal client, who just loves you for what you do and trusts you and listens to what you want. You can tell who those clients are based on the profitability of those clients. So you run a P&L. QuickBooks calls it a job profitability. There's a summary report and a detail report. The summary allows you to run that report and look at the gross profit percentage. Again, the most important number on the income statement. Look at the highest 15% margins clients and study what industries are they in. Why are we generating that margin? What's unique about what we delivered or about what our skill sets are, what our training is? And then look at the bottom 15%. And there's three things we do with our clients. We teach them how to, one, read and interpret the reports so they can understand why is it the bottom 15%? Where is that time leakage? Where is the hidden cost? And then go back to the client and give them one of three options. Number one, you need to increase their fees to reflect the true value that they're getting. The extra time, the extra services, the stuff your staff was giving away before you started tracking the time. The things that you did not include in your bid because you didn't know they were going to be a high maintenance client. Or you go with them and say, I can stay within your budget, but I need to take out of scope some of these things that we're currently doing for you, like being on the phone every week or answering emails every day, or just changing priorities means my project manager has to spend a lot more time. And then, or I need to transition you to another service provider. And what we found is over 80% of the time, our clients say, yes, either I'll pay them more money because you were able to show me exactly what I'm getting, or, oh, I didn't realize that it was going to cost me more to email you every day, to have a weekly phone call. I can go back to a monthly call or a biweekly call, and we'll stay at the existing fees. And what that does is you get addition through subtraction. You get more profits from the people and the clients you already have, or you move them out and you replace them with somebody new that's going to be priced right.
Yeah, that makes a lot of sense. And there's so much we can get into there. One thing to backtrack a little bit, I'd just love to hear your thoughts on owner salary. and I've read a lot about the idea of needing to create a market-based salary for an owner. But in my experience, agencies are all over the place. Most people underpay themselves. What's the right way to ramp up to the right level? Like, how do you think about that and creating incentives with partners?
It's everything we've been talking about today. The reason why owners and partners are not paying themselves is because there's not enough profits. There's not enough cash flow. At the end of the month, you get paid last after everybody else. And what you need to do is you need to start with profits first. You need to define, okay, how much profit do we need to make in order to pay ourselves $150,000 or whatever the number is that is appropriate for your years of experience, the city that you live in, the value that you bring. You start with how much profit do we need to make in order to be able to pay ourselves? And then go through the steps that we just mentioned, which is number one is, price your jobs to cover your overhead, and on each job, it's share of the overhead, and create that profit, because the owners, you can bake yourselves into the budget all day long, but the reality is, at the end of the month, if the cash isn't there, you're the one who's going to suffer. And the other thing I often find is people think they can sell their way to profits. And that if I just grow 35, 40%, I'm going to have more profits at the end of the day, because my overhead won't change, or we're going to make more money on these new jobs, when in fact, growth causes money. I have a lot of agencies that we've talked to that says, you are better off being a $2 million company making 15% profit than being a $3 million company making 5% profit. So, I heard yesterday from a company, he said, revenue is vanity and profit is sanity. And it's not how much you earn, it's how much you keep that matters. And we often forget that. We think that sales will solve all ills. Now, you need sales to have a growing company. I'm not suggesting you don't invest in sales and marketing. What I'm suggesting is the most important thing is to price right. And before you figure out which target audience you want to go to, who is the ideal client, study the past to help you predict the future of profits.
Yeah. And back to what you were talking about earlier, there's the idea of pricing right, but then there's also the sort of push-pull of getting people into the door, in a low-risk way. Are there any useful, benchmarks or heuristics for thinking about that? Is there a minimum that, you recommend the clients keep no matter what happens? This is what people need to invest with you to get in the door. I guess I'd just love to hear your thoughts on how to de-risk things as much as possible without shooting yourself in the foot, basically.
Yeah, I'm just trying to think about some of our clients. One that I really like, they do a diagnostic up front, mm-hmm. and they get paid for it. So, there's $1,000 to come in here and do an assessment of your current collateral, your messaging, your case studies, your personas, whatever it is that you need. And what that does is it allows you to be able to put forward a value-based proposal, because you come in with more knowledge about how you can add value than somebody else who just comes in and says, yeah, this is typically what we do. To do a website, it costs you this. We'll do 3 blogs a week. It costs you that. You've got to be able to demonstrate your unique selling proposition to an ideal client profile. And I find the companies that are the most successful, well, first off, it starts with the right mindset. You cannot come at this from a position of fear. That's the biggest problem. The difference between the companies that are wildly successful and the ones that struggle are the ones that understand that you're in business to make money, and we're not going to take on clients that do not cover their overhead and generate the profit target. Because otherwise, you work too hard. It's difficult to be an entrepreneur. And the ones that are really successful are confident and go in and say, look, here's what we cost more, but we've been doing it long enough to be able to demonstrate confidence that we can deliver you the results we're promising. And I also, as a business owner who spends $1 million a year on sales and marketing, we look at the lifetime value of a customer and compare that to the cost to acquire a customer. I never thought about this before, but it would be interesting as an agency to go in there, if you're doing this diagnostic, and say, look, this is what you have spent so far on customer acquisition. And you mentioned CLTV, right? Customer lifetime value. And it's just, let's go through that math, right? What's that? What does that mean? That is the gross profit that you make on a client times the number of months that a client's going to stay with you, or years that a client's going to stay with you. Again, another reason why gross profit is the most important number on the page. So you look and see, what's the value of that customer? How much profit did that customer bring to us? Sometimes business owners will look at this and say, oh, this is a great client. I had an agency in New York City, in Queens, and they had Apple as their biggest account. And they were so proud of Apple. It's 40% of their revenue. And they came to us because they had cash flow problems. And we immediately said, they needed help with billing and collections because they had cash flow problems. That's why they came to us, right? Our outsourced bookkeeping, accounting, controller service will handle whatever pieces that you don't want to do yourself. And they were not good at the billing and collections. And they thought they had cash flow problems because of billing and collections. And we went in and said, within 3 months, we went in and said, your problem is there's not enough margin on the Apple account. It's not covering its share of the overhead. And it's definitely not contributing to the profits. They had 28% margin, and a business should have been 50% margin. They're like, well, what are we going to do? It's our biggest account. We can't risk losing Apple. What we said was, well, if you're not happy with your profits, you don't have a choice except to go back to Apple and say, we have to increase your fees, and here's the other stuff that we're doing for you that you're not paying for. Or we can get rid of the project managers and get rid of the weekly calls and lower your cost to stay within budget, or I got to transition you. And it took 6 months for them to have the guts to have that conversation, because they were like, what happens to our cash flow if we lose Apple? And we said, all you have to do is replace Apple with these 1 or 2 or 3 accounts that are priced right, and your cash flow gets much better. And you don't have enough talent to do all the work that you're selling. So they finally had the conversation, and Apple was like, oh, yeah, of course. Yeah, we need the project manager, and we want these weekly calls. Of course, yeah, no problem. We'll increase our fees. Over 80% of the time, if clients are happy with you, they don't want to change. And when you can show them what they're paying for, they're happy to pay you. You know what it's like when you buy services yourself. And what they did was they went from break even to the success of repricing Apple. They went and repriced all of their jobs. They made $1.5 million in the first year. 1 year from break even. This was a $6 million agency. So this is not a giant company, but they were really good at using the data to make data-driven decisions about how to price right. I don't know if that answers your question or not.
Yeah, no, that absolutely does. And I think we'll probably put this in the highlight reel for the episode, because that's a great story. I guess one question is, you talked about the importance of having the right data to make these decisions effectively. And I think one risk is sort of swerving by looking at the wrong thing at the wrong time or getting wrapped up in it. I think we're all prone to that. So I guess my question is about reporting cadence. Like what should you look at the right times? Like what do you recommend your clients check out at different periods in the business?
Well, I'm a process guy, right? I like to establish habits. So, what I suggest is it depends on where you are in your business life cycle, right? If you have cash flow problems, you need to be looking at a cash flow forecast. We've created a great cash flow forecast that we do for our clients, where you can download your receivables and download the aged payables from QuickBooks, dump them into Excel, and then it just sucks up all that data into this template that we built with the Visual Basic Programmer. So you don't have to retype any of the customer information. It shows you the aged accounts receivable, what month, how past due are they. And then all you have to do is enter 1 through 13. What week do you expect to collect on that receivable? And then the same thing for payables. What week do you expect to pay? 1 through 13, when you're going to pay your bills. And then what it does is it summarizes the collection of the receivables and the payment of the payables onto a summary cash flow, 1-page scorecard that shows you 13-week cash flow. We suggest 13 weeks because it takes a quarter to see problems in advance and have enough time to deal with it. And then because it's Excel, you can add any other sources of cash and any other uses of cash that are not in payables, like rent and salary and anything else or that you're going to use cash for, or any other sources, and see in advance when you have cash flow problems. And if cash flow is an issue, you need to look at that at least every week. We suggest is every Friday or every Monday, you need to be looking at it and saying, okay, where are we? Because there's 3 reasons why businesses fail. They fail because of cash flow. They fail because of cash flow, and they fail because of cash flow. So if that's an issue, Maslow's hierarchy of needs, you got to deal with survival first. That's cash flow in business. Assuming then you're past that stage, then you start to look at on a monthly basis. What are the key metrics for your business? And you need an income statement and a balance sheet just to be able to show you the rear view mirror of the company, right? What happened last month? What happened in top line and what happened in bottom line and what happened in my equity on the balance sheet? I always suggest look at your equity. Did that go up or did that go down? That's one real easy way to see if your business is doing better or worse. But what we also suggest is there's a big difference between that income statement and balance sheet. those are financial statements. They're historical, designed for compliance, right? Designed for the IRS and the bank and the auditor to make sure that they're happy. What you really want is management reporting. That's what GrowthForce specializes in, is helping you get data to make decisions. So the reports you need to look at need to depend on what kind of decisions are you making. If pricing is the decision you're trying to make, which I encourage everybody to start there, that's the number one decision you have to make. Then you look at the profitability by customer, by job every single month and focus on the bottom 15%. Just do what we talked about before. Where is the time leakage? Where are the things we're not getting paid for? Where did we make mistakes in pricing so that we can fix that for the next time? And then there's a lot of other reports, but that's the big ones, is to focus on that profit and loss by customer, by job report. And then I also would look at it, by what decision you're trying to make. We have a client called Chief Outsiders. They're chief marketing officers, right? Outsourced CMOs across the country. We've been working with them for 10 years. Art Saxby started the company. He just hired us to do the QuickBooks file. He's like, I got to send an invoice. I lost my job. I started this agency. I got my first customer, and somebody told me you guys know how to make turn QuickBooks into a managed reporting system. So instead of sending an invoice out in Word, can you set up QuickBooks? And while along the way, now we do everything for them. We do billing, collections, bill payment, financial reporting, commissions, everything. When a new customer comes in, the first call they get is from GrowthForce to say, hi, welcome to Chief Outsiders. I'm Kyle from GrowthForce, Chief Outsiders Outsourced Accounting Department. And we want to go through the contract and make sure that you understand the terms of the agreement so we can make it easy for you to pay the bills. And here's a tip for cash flow. Before you start any work, call your customer up and ask them, so here's the contract, here's the terms. When do you pay bills? Who pays the bills? What kind of supporting documentation do you need in order to prove that bill? How do you want to get that supporting documentation? Is Dropbox okay? Is an email with a scanned image for receipts? And is there anybody else who has to approve the bill before you pay it? And what that does is it shows you to be very professional in the way you run your company. It also solves your cash flow problems because you start doing billing and you don't have the right supporting documentation, or you send it to the wrong person, or you send it the day after they do their bill payment once a week. Then you'll solve a lot of those problems before you do any work. But what Art wanted to know, he emailed us one day and said, hey, I just got this bill to sponsor this big program that we did last year, and it's six-figure bill, a marketing campaign. And I'm a partnership for tax purposes. We distributed all our cash in December. I don't have six figures. Can you tell me how much revenue we earned from that lead marketing campaign last year? And we wrote back and said, yes, we can, but you were asking the wrong question. He should have been asking, how much profit did he make? And but what you can do is anybody can do this on any accounting system. Go into the accounting system and add a custom field called lead source. And then record, where did you get that each customer from? What was the primary lead source for that customer? And then you can run your job profitability report by lead source. What it allows you to do is to see what's the return on investment we got from that sponsorship, from that trade show, from that website investment. And now you can start to study what's working from a marketing campaign. In fact, what Art said is, I need you to go do this for my clients because they're always asking me, how do I measure the ROI on your work? And this is one easy way to do it. Once you allocate your people to a customer and job, now you can start to slice and dice that any way you want based on the decisions you're trying to make.
Yeah, that's super useful. It makes a lot of sense. And I've taken more notes on this episode than I usually do. So kind of, getting towards the end of the time, Stephen, there's the great, Taleb quote, which is don't give me advice, just show me your portfolio. And while I don't literally want to see your portfolio, I'd love to know, what are you doing within your company to get ready for the next year? And what do you think is going to happen in the next year to kind of put you on the spot and make you prophesize?
Well, a lot. We have really doubled down on our advisory services because what we found is in this last year, we've spoken to 1,800 business owners, and there's so many that have a good bookkeeper, real good full charge bookkeeper that are really happy with them. They trust them, but they're self-taught. they're not an accountant. They don't really understand what an accrual means and what a month-end close really needs to look at, so that when they get an income statement, one month they show big profits, the next month they show losses. Why did they show losses? Well, they're biweekly payroll. They've got 3 payroll periods twice a year. And so what accountants do is they come in and they put some basic accruals in place to help make sure that you're recording the revenue that was earned each month, and you're matching the expenses that were incurred, regardless of how many payrolls. You didn't pay more people. You didn't add any staff. The payroll wasn't being recorded right. And so our advisory services group has really helped businesses move from bookkeeping to accounting, move from cash basis reporting to accrual based reporting that really shows you the true economic result every month, and then helps them read and interpret the reports, helps them understand, what does it tell me? What do I do with this information? And that's really exploded for us. I'm a CPA, right? The traditional CPA who does outsourced bookkeeping and accounting issues an income statement and a balance sheet and then sends it to you and says, here they are, call me with any questions. With our advisory services, we've taken a whole different role, which is, what decisions are you trying to make? What are the data that you need to make those decisions? Now let's set up your system to do that. And let's teach you. We're going to teach your bookkeeper how to do some accounting, teach you, the business owner, how to read these reports. So now you can actually be confident that you're making data-driven decisions to increase your profitability.
Awesome. Makes sense. And with that in mind, I'd love to hear what you're up to. I know that there's some projects you guys are working on, and thought leadership, eating your own dog food, which is great. So I'd love to hear about it.
Yeah. We just launched a Getting Stronger in a Recession. 5 steps every smart business owner needs to take right now to help manage and improve your cash flow, help you figure out what data should you have at your fingertips. And then how do you restructure to make yourself stronger? How do you figure out what cuts to make above the line versus below the line? And then how do you sharpen the saw? How do you come out of this a better company? How do you automate the back office? Budgeting is the most important thing you can do to change the trajectory of your business. Harvard did a landmark case study which said the simple act of writing down goals will increase your likelihood of success of 82%. And that starts with a good budget. So we have this 5 steps to getting stronger in a recession webinar that is on our website. And that to me is kind of a real great step-by-step way to take all the things that we've talked about today and put them into action.
Cool. Makes a lot of sense. We'll make sure to get that linked up. Stephen, thank you so much for your time. Appreciate it.
Dan, thanks. And anybody wants to reach me, I'm Stephen with a PH, STEPHEN @growthforce.com, or www.growthforce.com has got all of our resources available.
Awesome. We'll get that linked. Appreciate it, man.
Thanks, Dan.